So the next technique we'll look at is the life cycle costing. The life cycle costing. So we need to look at how to understand this concept and also the stages available, and also we'll look at the advantages and disadvantages of product life cycle costing. I would recommend you to look at this video. It's a very good video. It does explain the product life cycle for iPhone, Apple, and also for Coca-Cola before you continue with this lecture. So now, life cycle costing. So what's to do with life cycle costing? Life cycle costing, it involves collecting together the cost of single product or service of its entire useful life. So remember that any product or service has its life, its useful life. So let's go back and see when you used to listen to music. So we used to use what's called the cassette, and then after that we upgraded to CD, then DVD, and then nowadays we are not using anything. We're using MP3 and internet. Can you see, guys? This is any product or service has its life, and the number of years could be any years, could be 10, could be 5, could be 20, could be 30, whatever. So at the life cycle cost, every single year you calculate the cost and also the sales in order to see how much profit you're making for every single year. So this will help as a business to expect for next year in terms of sales and also in terms of cost. That's all based on estimation. We estimate the sales and we estimate the cost. Now in terms of the life cycle costing, there are 5 stages of product life cycle, and the first stage you start with the research and development stage. At the research and development stage, as you see, there is no really sales. There is no really sales volume including, because this is at the first stage. After the research and development stage, we will look at the introduction stage, which include we launch the product in the market and people start buying the product. At this stage, as a business, they will invest heavily in advertising and a promotion in order for the product to reach to all customers there. So after this stage, the third stage would be the growth, which the kind of the product is familiar and it's growing. After the growth stage, we will come to the maturity stage. Maturity stage, where the stage is the product was established. The product was what? Was established. So it's very popular. Everybody knows about the product. So this is maturity stage. We don't know as a business how many years could be maturity. Could be, for example, look at some businesses, they still in maturity stages and been for 20, 30 years, isn't it? So it all depends on the product, isn't it? Depends on the product, depends on the competition, depends on the technology. It all depends. But at the maturity stage is what is the product was established now. So after this, as a result, of course, we will go to the decline stage. Decline stage. Why is decline stage? Very simple. Consumer buying behavior change. A lot of products in the market. Competition is high. A lot of competitors, they're trying to do the same product, lower price, etc., etc. So as a logic, we think that we started seeing decline in the product in terms of sales, in terms of sales. And this is exactly what's about the product life cycle. In every single stage, we calculate the cost, estimated cost, and also the estimated sales. And as an accountant, management accountant does the job. It does help for the business to make better decision making. In terms of the life cycle costing, of course, as I mentioned, it does include all the cost involved in any stage, including the 5 stages: research and development, such as design, testing. We've got also the training cost, we have production cost, we have marketing cost, we have distribution cost, inventory cost, and also we have the last thing, we have the decommissioning cost, where we rid of the production line. We're rid of the production line. All these costs are included under the product life cycle. Okay, let's have a look at question number 3. So if you look at this question, the question asks you, in calculating the lifetime cost of the product, which of the above items will be excluded? So as you see, research and development cost is included, design cost is included, testing cost is included, the advertising cost is included, and also the production cost. So can you see? So the answer would be, of course, none of the above. So all the costs are included in the lifetime cost of a product. Right, let's have a look at this question. Right, Snowflake Co. are in high technology sector, in high tech industry, and often first to market with new technological advances. That's fine. They have recently spent £500,000 designing and developing a new product. So that's at the research and development stage, which cost them £500,000. The new product is expected to have an 18 months life cycle. And especially, don't be surprised, guys, when you say 18 months, only 18 months life cycle. Yes, it's 18 months life cycle, especially when you talk about nowadays about technology stuff. Yeah, we are in technological tsunami. It's every day there is a new technology. Yeah, I remember, look at do you remember the Japanese game Pokemon? Yeah, it was a few years ago, isn't it? I'm not sure how much money, it's billions, and the life cycle was a few months. Can you see? It's not about how many months you think. 18 months, this means the business doesn't make a profit. It's not always the case, especially when you talk about technology products. Anyway, let's have a look at the 4 stages. Include the introduction. We expect this to sell 4,000 units. When it comes to growth, 9,000 units. When the product was established, we expect to sell 30,000 units. And at the decline stage, we expect to sell only 10,000 units. And every stage, that's in terms of selling a price, 599, then in a growth 549, in terms of maturity 449, and decline 349. Of course, when it comes, as you see, when it comes to maturity, the price will decline. Well, the price will be reduced, the same with the decline stage. Why? As I mentioned, because there's a lot of products will be in the market, and a lot of competitors will try to do the similar product. In terms of variable cost, as you see, the variable cost per unit, as you see, is being reduced over the stages. Again, when you look at the product when it was established, of course the cost per unit will be less. We know the product, we understand the product, so we don't need a lot of training, so we are leading in this product. So of course, as a result, the cost per unit will be less. In terms of overhead cost per unit, when I say overhead is indirect cost, again, that when it comes to it, that gain will be reduced in terms of fixed cost per unit or overhead cost per unit. And the question asks you to calculate the profitability of the new products. So again, it's all based on estimation. So this data will help the business if it's worth to launch this product or not. Of course, they shouldn't rely only on product life cycle costing, but it's one of the techniques they should look at in order to make a better decision making. Right, let's have a look. Now, if you look here at the answers, you will see that at the development stage, they spent 500,000. So this is a loss of 500,000. Introduction, if you remember, they sold 4,000 units. And what you need to do, you just need to multiply this 4,000 units, multiply it by the selling price per unit, which is 599. And the answer is 2,396,000. And you multiply it by the variable cost per unit, 249 times 4,000, 996, and also you multiply it by 4,000 units times 100, that's 400,000, so or 400. So revenue minus these costs, of course the profit will be 1,000. So what you need to do right now, you need to work it out in every single stage is the same. So every single stage goes exactly the same. Introduction stage will be the same, growth stage you'll do the same, and maturity will be the same, and the decline will be the same. And if you look at the results, what you can see, of course, you can see the highest profit would be at the maturity stage, but again after will be decline. But overall as a business, we will look at the profit overall, and you see the profit here is 9,250 or 9,250,000 pounds. So as a business, you look at this result and you think, it's promising. Yeah, looks promising. So yeah, that's one of the techniques can help to make a decision. Here we go, promising, here we go, let's go for it. So in terms of question number 4, what I want you guys to do right now, I want you to go and try to do this question in your own, and after that come back and look at the answers there. So for this company, the managing director believes that the customer only will be prepared 475 pounds per piece of the equipment. Okay, so this is what he thinks or she thinks, 475 pounds per piece of the equipment per unit. But the management accountant believes this will not cover the cost over the life equipment. Look, now the management accountant or the financial controller job now saying, okay, I really doubt that we will cover 475 per unit. I really doubt. That's what they think. Really doubt. So as a business now, what they need to do, or as a financial controller, they need to calculate and prepare the statement of product life cycle costing and see if this gonna work or not. So they can find out how much would be the cost per unit. How much would be the cost per unit, and the data is there. These are the figures which you need to use in order to calculate the cost per unit, So including year 1, year 2, year 3, year 4. So the units available here, as you see. Also we have research and development stage in year 1, year 2. We have marketing over the 4 years. We have a production cost. We have customer service cost. And at the end of year 4, of course, we need a disposal of specialist equipment. So as you see, these all the figures available in order to calculate the cost per unit. As you see, what you need to do, what's your job really? You need just to combine them. You really need to combine all of them here, because you do not need to multiply the units by the variable cost or by the production cost. Why? Because the question gives you the total production cost available. So you don't need to worry about, you just need to add them all together. Research and development, add up all of them together, count them. Marketing the same, production cost the same, customer service cost the same, and disposal of specialist equipment the same. So if you do this for each single, for all the years, 4 years together, you should be able to find these figures in terms of research and development. So the total over the 4 years, 1,650. In terms of marketing, 155 over 4 years. In terms of production cost, 10,725. And in terms of customer service, 1,315. And in terms of specialist disposable, it's 150. If you add them all together as total cost, you should be able to find 13,995. And of course, if you divide it by number of production units, which is 29,000 units, so you should be able to find that the cost per unit is 482.59. So from this perspective, so you think that the financial controller is right by suggesting that we will not cover the cost of the £475, which is the selling price per unit, because this is the only price which the customer can pay. So we can't do it, isn't it? As a business, we can't do it. If we are making it, we are making a loss. We are making a loss almost £7.50 per unit. So as a business, we need to look at some other techniques and make a better decision making. But from this available techniques, I think this project will not go ahead. Okay, right. In summary, you need to understand that life cycle costing is very important, because at every single stage it does consider all the cost and all the revenues at every single stage. So, and also look at the whole period. Also, you need to look at the 5 stages available at the product life cycle, including the research development, introduction, growth, maturity, decline. So these 5 stages, some companies, they have another stage at after maturity. So maturity, when they see the product was established, it's strong in the market, so they have extension, something called extension stage. So these, when they can develop in the same product, develop other lines. For instance, I would say, for example, you talk about Coca-Cola Zero, stuff like this, the sugary stuff. So these type are called at extension stage. And after that, of course, will be the decline. So in terms of advantages and disadvantages, remember that product life cycle costing, it's really important, because as a business, it does help to plan for planning. It does help to see, to understand in every single stage how much cost is involved and how much also revenue is included, and also does help to make a better decision making. It does help to make a better decision making. In terms of disadvantages, remember, it doesn't always work like this. What do I mean it doesn't work like this? Okay, this is a typical in theory. In theory, we say, okay, product will go research development, then introduction, then growth, then maturity, then decline. That's fine, but not always like this. Some product might reach a growth, and after that straight away declines. Straight away. There's a lot of products like this. Yeah, straight away declines. So it will not reach to maturity stage. Yeah, so think in theory but not in practice. So think that not always the case to go through the 5 stages there. Okay, this is again in summary, product life cycle costing it does help. It does help the business to make a decision, but always remember the business cannot rely only on the product lifecycle techniques in order to make a decision or launch the product based on it. So they have to look at other techniques and other, of course, other data. Right, the life cycle or product life cycle technique, here we go, and the last one we will look at, or the last technique we'll look at here, is Kaizen Costing. Kaizen Costing. So please, for this one, can I ask you please to watch this video before we continue the lecture. So Kaizen Costing means for continuous improvement. Is a Japanese term. Japanese term is for continuous improvement. So what's about Kaizen Costing? What's about Kaizen Costing? In the business, especially Kaizen Costing was introduced in Toyota. They encourage employees to look at small improvements in operations. To look at small improvement in operation. At Toyota, if you watch the video, you will see that the management introduced this this technique and encourage the employees there to find it small. So I think every employee has 1 or 2 Kaizen to do every month, so they have to find improvement for something. Yeah, so of course they have to find issues, problems, and also suggestions, okay, solution for this issue. So try to improve things, small things to improve there. So it's a culture, isn't it? It's a culture that they improve things and improve small things there every time through operation there. So of course when you talk about improving, that could reflect or could impact on anything. Could be eliminating waste. How can I eliminate waste? Material waste. How could eliminate the idle time? Yeah. How can I find more efficient ways of doing something? Yeah. Again, that all will help to increase the sales and as a result decrease the cost, and of course as a result the profit will be higher. In terms of Kaizen Costing, as I said, the business should encourage the employees to do this, and also remember that if the continuous improvement or the Kaizen Costing is improved, remember that the gap between the actual and the target cost will be reduced over time. Because you remember, one of the things when the business set up budgeting, so a lot of business, they don't achieve really the budget cost. Some people, they go over it, and some people, they go below it. But again, Kaizen Costing can help in order to reduce the gap between the actual cost and the target cost. Target costing and Kaizen costing. So when we introduced target costing, we did say that target costing it does happen at the initial stage of a production. Yeah, and we remembered that target costing, if there is a difference between the target cost and the estimated cost, we create something called cost gap. There's something called cost gap, and there are some ways, strategy to decrease or reduce the cost gap, if you remember. So Kaizen, it applied after a production started. So production is there inside an operation. We try to improve things. We try to improve things there. In terms of target costing and Kaizen costing, so remember that the target costing requires significant changes to be made in terms, we did say, in terms of how to reduce the the cost by, for example, changing supplier, changing material, or replacing quality material, but don't compromise with the quality. Quality should be the same. Labor, low skills labor, value engineering, if you remember, again. But when it comes to Kaizen costing, we focus on small improvements to the whole process at the parts of the continuous improvement. So this is called Kaizen costing. And remember, guys, that that Kaizen costing, it's important, and you need to apply it in every single stage of your life. It's not only the businesses. So even as a person, right? As a person, you need to remember that we also need to improve, isn't it? We need to improve, and this is nice thing to apply Kaizen. How I improve things, how I can improve. For example, if you sleep late, that's maybe a small thing you can improve, and sleep early and get up early for a better day, isn't it? There's a lot of things we can improve. I remember when I went to Cardiff to have some waffle. I remember in Queen Street there is a waffle shop. I forgot what's called. Right. Anyway, so I went there, okay, with my colleague, and I think we need to go downstairs. There's a steps, right? We need to go downstairs there, and we went there anyway. So I asked for waffle. My colleague asked for, I think, a drink, for cappuccino, I think, I don't remember. Anyway, so when they brought it, anyway, they took the order. Then when they went up on the stairs, and they came down and they brought the order maybe after 15-20 minutes, and it was only one fork and one knife. Okay, I asked my colleague if he wants to try it, so he said, okay, I might try it. So what I asked, we were alone downstairs, with some customers, but it wasn't any really assistant or help or any chef, right? So basically I had to go upstairs. To ask them for a fork and a knife, and come back down. Yeah, and you see this process, it cost from me around 1 minute. Yeah, around 1 minute to bring them down. Okay, so what I suggest for the business, I told them, okay, why not applying Kaizen costing and try to do small things, small improvement. Yeah, why not bring in some forks and some knives downstairs? Want to bring in some forks and some knives downstairs, put them in section there. Okay, that customers can use them there, instead of customer waiting for the customer assistant, or the customer assistant will come and then they will go and they will come, and that's not efficient. That's not really efficient. So anyway, this is one of the possible solution. I mean, this is one solution, but the business can introduce it another solution. Yeah, but again, my point here, guys, so remember, as a business, there is no business is perfect. Every business has issues in terms of operations, in terms of efficiency, whatever. There is a problem. Yeah, there are issues, and again, this is the way the business needs to encourage employees in order to apply this Kaizen technique and apply a few things in order to eliminate the waste. And another example before I finish the lecture, it was funny, but I go to the village hotel for swimming and for the gym, and if you look there, seriously, if you go there, you will see the lockers. Most of them are broken. Yeah, so basically I need to search for a locker, it's working, so I can use it. And again, that's small things. One employee, one staff can raise it to the management and say, come on, those lockers are broken there. This is a small thing. As a business they need to improve their operations. Yeah. So as a customer, right, if you calculate, right, if I spend 2-3 minutes every time I look for a locker, okay, same with how many customers come. Let's say 200, 300, yeah, multiply by 2-3 minutes. Can you see the time is wasted? Customers searching for not a broken locker, and that's, if the business want to do it, that will cost them will not cost them really huge amount of money, isn't it? But look, the efficiency will be quicker. The operation will be quicker. So again, these small things, the small improvement the business needs to look at in order to improve the business there in terms of operation, eliminate waste, and of course reduce the idle time. So right, so this is all about these techniques are important. Cost management techniques are important, don't forget this. So nowadays with this environment, management needs to think twice, and they need to really to gain competitive advantage in the market by introducing these techniques into the business. Right, so thanks for listening, guys. I hope you're having a lovely day. So take care of yourself, and God bless.